Well, the Reserve Bank Governor, Michelle Bullock, was asked how line ball the decision was to cut interest rates, despite certainty in the markets that it was a done deal. And you would have seen all the reporting suggesting it was a done deal. She says it was a difficult decision in the sense that there were arguments for and against, and that the bank is still very cautious that the inflation fight is not over and that they will be watching very closely. In terms of the market that's priced in interest rate cuts, a couple more this year, she says that she would not be relying on that they will be very cautious. That's why economists have described this as a very hawkish rate cut. So today, let's go straight to my panel of economists to really tease out what is a very significant decision, of course, politically, but for people who have mortgages, a huge day. CEDA senior economist Andrew Barker and Jarden's Michaela Fuchilla. Welcome to both of you.
Thanks.
Thank you.
I want to start with you, if I can, Andrew, on the decision itself. Of course, overwhelmingly, this was expected, but are you surprised by how candid the governor has been about the fact that it was a line ball decision and that they certainly were not, they were not overly confident that this was an overwhelming decision that they made?
Yeah, certainly it comes across as a hawkish cut, as you just said. We were expecting a rate cut, as were most other economists, but we weren't as confident as the market was. So we've seen inflation is coming down, so there is success there. The Reserve Bank, of course, looks at an underlying measure of inflation that takes out those sort of items that fluctuate in price a lot, like petrol prices or food, so they can get a better sense of the momentum and the real strength of price increases across the economy. And that's down to 3.2%, which is still just above the Reserve Bank's target band of 2 to 3%. But of course, the Reserve Bank looks forward 6 to 24 months, which is the time for the full effect of its interest rate changes to have effect. And so they're looking forward at prices coming down into the future. As the Reserve Bank Governor said, it wasn't a lay down misere, and that was particularly around the strength of the labour market, where unemployment is still only at 4%. But that's not contributing to really strong wage growth. Wage growth has come down. The latest data, it's at 3.5%, and that's entirely consistent with bringing inflation sustainably back into the bank's target range. So we didn't see that as a reason not to cut.
Michaela, she said it was certainly a consensus decision. So there was agreement, obviously, on the board to cut rates today, and many people who have mortgages will be relieved to hear it. But a lot of caution in the voice from the governor. How do you read it?
I think it's more about the level of rates not being consistent with current economic conditions rather than easing policy to support growth. In fact, the level of unemployment that we have now is historically low. So there's no really need to support growth and the labour market in particular. Private demand, it's very weak. So I think that would have pushed them to provide a little bit of less restrictiveness, as they call it. The relief for the RBA is delivering this cut and taking a wait-and-see approach means that they can watch the data turn around. We know by higher frequency indicators that there is a little bit of a pickup in demand already. So it's coming from such a low base, then if you see that be more sustained, then rate cuts might be unlikely. But it's overall consistent with the view that insurance hike delivered in November 23 that dragged inflation at a faster pace than they anticipated back into target. It can now be removed as we were just discussing, as inflation comes into target at the underlying level.
One of the points that was made in the Reserve Bank statement, Andrew, but also reiterated there by the Reserve Bank Governor, was that they've basically revised up inflation a little over 2026. Were you surprised by that?
Look, that reflects that they base those forecasts on market expectations of interest rates, and interest rates in the market expectations, there's expected to be 3 more cuts by the middle of next year. So it's important to remember that that's conditional on that, and also that there's a lot of uncertainty, right? At the moment, there's a lot of uncertainty about global trade policy. There's uncertainty about policy in Australia with the federal election coming up. There's uncertainty about what will be the effect of this rate cut on the economy. So I think there's a lot of a lot of room for movement around that forecast.
And Michaela, I did note that the Reserve Bank governor said very pointedly that she's aware that the markets have priced in a couple of extra interest rate cuts this year, and that basically telling people, this is my language, but just to cool down and not to factor that in. How did you read that?
Oh, actually, unusually enough, I agree with market price in that there is some more easing to come. I don't agree with the idea that May will be the next one. We expect it in July and then again in September, but it will all depend on what the labour market does from here, and also how or to what extent private demand can pick up. As Andrew said, there's several factors in play. Global growth might be impacted by the trade tariffs that will be taken into account. Measures of productivity growth, we'll get an update on that next week. And the RBA has taken a very much watch and see approach, which will support the view that the rates will be on hold. That way we avoid inflation expectations from getting out of control, and things like businesses getting concerned about the outlook for inflation in the near term. One comment that I thought it was interested in the statement was that consumers remain extremely sensitive to prices still. So even though we have seen inflation coming down, there is a lot of uncertainty around the reaction function when we know cutting rates will potentially boost inflation. That said, one cut is really not going to make a difference.
No, and it's still very much sort of constricting the economy. There's no doubt about it. It's only one rate cut, but a rate cut I know that many people will be relieved by. I'm really interested in the unemployment rate and the way that the RBA is considering the unemployment rate, which has remained pretty low, which is a point that the Reserve Bank governor made. She was asked about this and what the uncertainty was. Why did they consider today? Why were they reluctant maybe to cut the rate even though they have? And she said it was around the labour market being so tight. Andrew, you've raised this. I mean, we've talked about this. It seems that the RBA is still not certain about how to land here. Am I right?
I think that is right. I mean, I think there's a factor in inflation has been slow to come down, and that's been a consideration that maybe that was because the labour market has remained quite tight. But there's also been these sort of slow-moving items that have been really important. So things like insurance costs or housing rents that have been very slow to come down, that have been driving inflation in this cycle, are now starting to come down. And so we're seeing that movement in overall underlying inflation. And that then means that we can now look at this still relatively strong labour market with 4% unemployment, see that that's not driving inflation because it's only leading to 3.5% wage growth, and maybe be optimistic about the possibility of locking in a relatively low unemployment rate, which would be a real success compared to other countries like New Zealand or Canada, for example, where the unemployment rate's above 6.5% now.
Yeah, the unemployment question, Michaela, is obviously a huge one. It has been confounding, as some economists, that unemployment has remained low, and obviously we've been on a journey to try and get inflation down. What was your analysis of what we heard from the RBA governor about the way they're considering the unemployment question?
So I think something to keep in mind is that the unemployment rate bottomed at 3.5. So it has actually come up. In a previous cycle where unemployment, if unemployment was around 5% and it goes to 5.5, there would not be any doubts that we need those cuts to support the labour market. But what we learned in this cycle is that unemployment can actually go as low as 3.5. And that makes the question a little bit more structural. Is it a change in the natural rate of unemployment or the neutral rate of unemployment, or it's just a cyclical factor, pent-up demand potentially from having reopened the borders, high population growth, creating more demand? So I guess this cycle is a lot more uncertain and justify why the RBA needs to take a cautious approach. But the current economic data is showing that the RBA has avoided a recession, that unemployment can actually go lower than initially thought, and that wages pressures can be contained. but at a higher level than they were before. Remember, in previous cycles, we wouldn't see inflation at the underlying level going above 1.5%. So in some ways, there's a lot of learnings in this cycle, which I think are very positive, but it does show that the RBA has managed to achieve that narrow path.
Yeah, they've certainly taken a very cautious approach, which was articulated really repeatedly by the Reserve Bank governor. And so just would like to kind of, if we can take it back to the household level with your analysis, for people, and then, you know, the Treasurer's Office has provided details on what they understand will be the kind of financial benefit for people who have different kind of mortgages at different rates in Australia. In terms of the financial benefit, obviously Australians who have big mortgages will see more money in their pocket, but what kind of economic impact is that likely to have, Andrew? I mean, what's your read of what that will do to the economy?
So the immediate effect is exactly that. People with mortgages have more money in their wallets, so about a $115 saving for someone with a $750,000 mortgage, which is obviously really eases the pressure on them, and people have really been feeling this cost of living crunch over the last couple of years. They're also benefiting because inflation is coming down, so it's positive there too. This interest rate cut, it's just one 0.25 percentage point cut, so the effects are marginal, but certainly that should help to boost spending because people have more money in their wallets, and also contribute to greater investment, which is a really important driver of economic cycles and is very weak in Australia at the moment.
Well, it is very weak, Michaela, and that really kind of brings me to that part of the question. The economy is incredibly weak. It's very hard to see it any other way. This is one interest rate cut. The Reserve Bank governor is giving us the indication that we shouldn't, you know, price in more cuts to come. She wouldn't entertain questions in relation to when we might see more cuts. So what sort of position does that put the economy in, given, you know, some people have been saying the economy barely has a pulse?
Yeah, and I would agree with that. Like, if you consider how significant the impact from public spending has been, and that has been the main driver of growth. So the private sector has been quite weak, and economic growth at 0.8 year on year is extremely weak. So in one sense, yes, we need that support from the growth perspective, but as long as people are in jobs, then there's no an immediate need to ease. A few things in terms of the impact of this cut is that all the assessment from the RBA research is based on 100 basis points of cuts. That they estimate has a 0.5% boost to growth across a 2-year period. And also on inflation is very minimal, about half of, or 25 basis points across 2 years. So there's really not much evidence on how one cut will impact growth. But I would say two things. The first one is sentiment should improve for businesses and consumers. And this is mostly to do with the idea that the hikes are behind. So for now, the consumer might feel better about the spending, but that hasn't yet been reflected in the data. Consumer confidence remains really weak. And I think, as the RBA said in the statement, the inflation expectation will be a big factor in this cycle.
Andrew, I'll give you the final word, and you've been excellent panellists. Thank you for talking to us on the back of the Reserve Bank Governor's press conference, which I know was hotly anticipated. But in terms of what you expect over the next couple of months for our economy that has been struggling, will this provide any stimulus?
So we're expecting a gradual recovery in the economy. It is quite weak. We'd really like to see stronger productivity growth. So that's really for Australian businesses and the Australian government in terms of policy. And if we can boost productivity, then we can get stronger growth and combine low unemployment with low inflation as well. In terms of the immediate outlook for interest rates, as I mentioned, there's a lot of uncertainty around. I think the Reserve Bank will be really looking to see the next round of data, and the full inflation data doesn't come out until the 30th of April for the next quarter.
We will be waiting 30th of April. Put it in your diaries. Michaela and Andrew, it's been great to have your economic minds on the program this afternoon. Often people see these things in a political prism, but of course, real Australians right now are feeling like there might be some relief for them. Thank you for helping us navigate it.